Okay, let's unpack this. We are seeing one of the fastest, probably most consequential collisions happening right now in modern finance.
Yeah, this real simple.
You've got this, wild, decentralized world of crypto on one side.
Right.
And then the other side is this deeply entrenched, massive pool of Wall Street money, TradFi as we call it.
Traditional finance, yeah.
Yeah.
And they're not just watching anymore.
No, exactly. For the first time, Wall Street isn't just sort of peeking over the fence. They're actively trying to integrate crypto.
Fully integrated.
Fully. Not as some niche thing, but as a core, potentially trillion-dollar asset class.
And the mechanism, the key piece connecting these two worlds is the ETF, the exchange-traded fund.
That's the bridge.
That is absolutely the bridge. And the shifts we're seeing now, it's just monumental. What really drives that home for me is the sheer volume of proposals hitting the SEC.
It's not just one or two.
Oh, no. Asset managers they're flooding the zone. We're talking dozens of crypto ETF proposals landing on the SEC's desk right now. It's kind of incredible.
And the range of these filings, it shows just how comprehensive this institutional push really is. It's not just the big two anymore, is it?
Not at all. I mean, sure, Bitcoin and Ethereum spot ETFs, those are the headliners, absolutely. But the proposals go way beyond that.
We're seeing things like Solana.
Solana,
Yeah.
general DeFi baskets, collections of different decentralized finance assets, even thematic Web3 funds, trying to capture that whole ecosystem's growth potential.
So our mission today for you listening is really to define what this ETF wave means. These ETFs, they're the critical bridge, like we said, between Wall Street money and the crypto markets themselves.
Right. And we need to unpack the immediate impact, the billions that are already flowing across that bridge,
Yeah.
but also, crucially, the longer-term risks.
Especially the centralization risks, right? What does this deep integration mean for the original idea, the whole ethos of crypto?
That's the core question we need to explore.
Okay, so let's start at the beginning. We have to talk about the historic catalyst. Because this whole rush, this urgency we're seeing, it really kicked off with one specific moment.
Yeah, it traces back to the SEC greenlighting the spot Bitcoin ETFs in early 2024. That was it. That was the turning point.
A genuinely historic moment. It just changed the entire regulatory and investment landscape almost overnight.
It really did. It felt like a dam breaking, financially speaking.
Yeah.
For years, the SEC had been pretty firm resisting spot crypto products. They always cited manipulation concerns, custody risks.
The usual arguments.
The usual arguments, exactly. But once those first approvals landed, the whole dynamic flipped. It went from if these would ever get approved to when.
And the market's reaction just proved it, didn't it? That institutional demand wasn't just theory.
Oh, absolutely not. It was massive, and it was clearly just waiting for a regulated way in.
And the data, the data backed that up immediately. We're talking undeniable, immediate success. Can you remind us just how big those initial flows were?
The scale was genuinely staggering. It actually blew past most analysts' forecasts. We saw huge inflows right from day one.
How much are we talking?
Over $10 billion. That flowed into the new Bitcoin ETFs in just the first few weeks.
Wow, 10 billion.
10 billion. And that's not just, retail investors being curious. That is serious institutional conviction. Wealth managers, family offices, hedge funds. Capital that simply couldn't or wouldn't touch raw Bitcoin before.
So it proved unequivocally that the institutional demand is real. It's deep, it's liquid.
Yes, and that set the stage for everything else we've seen through 2024 and what's coming next.
That kind of success must have felt like a starting gun for every other asset manager out there.
Oh, absolutely.
They saw those billions flowing into BlackRock, Fidelity, and thought, we need a piece of that.
Precisely. That success is what's fueling this current rush for new products. Asset managers looked at those numbers and realized they were in a race against time.
A race for what, specifically?
The goal now is this frantic sprint to get their own Ethereum ETFs, Solana ETFs, maybe these multi-asset crypto baskets filed and, crucially, approved before the next big bull cycle really takes off.
Right. Nobody wants to be sitting on the sidelines if there's another massive run-up.
No major financial institution wants to miss out on what could easily be the next $100 billion wave of assets moving into this space. It's pure FOMO, but at an institutional scale.
It really does feel like a gold rush mentality. But, as we touched on, this shift wasn't entirely voluntary, shall we say, on the SEC's part.
No, not at all.
The SEC didn't just wake up one day and decide they loved crypto ETFs. This whole thing was actually forced, wasn't it? We have to talk about the Grayscale lawsuit.
Yes, the Grayscale versus SEC court victory is absolutely critical here. That case is the legal engine driving almost everything we're seeing now. You could argue it's even more important than the initial inflow numbers.
So Grayscale, they had this huge Bitcoin trust, GBTC.
Right. And they wanted to convert it into a spot ETF, which would make it much more efficient, track the price better, lower fees.
But the SEC said no.
The SEC denied the application. So Grayscale sued them, and importantly, Grayscale won.
And winning that case basically blew up the SEC's main argument against spot products, right?
It neutralized it, exactly.
What was the core reasoning the court used? Because this is where it gets interesting legally.
Well, what's fascinating is the court essentially called the SEC's denial arbitrary and capricious. That's strong language from a federal court.
Why arbitrary?
Because the SEC had already approved Bitcoin futures ETFs. Those track the price of Bitcoin derivatives traded on regulated exchanges like the CME.
Okay.
The court's logic was, if the SEC is comfortable with the market surveillance for the futures market, which, by the way, ultimately settles based on the underlying spot price, then how can you logically deny a spot product that relies on the same underlying price discovery?
Ah, so they couldn't distinguish the risk profile convincingly.
Exactly. They ruled the SEC couldn't treat the two products differently, since both were exposed to the same potential manipulation risk in the underlying Bitcoin market. That ruling was basically a mandatory instruction. SEC, you need to reconsider your approach to spot crypto. It turned them from a gatekeeper saying no into a reviewer assessing how.
That's such a crucial distinction. It's a mandate based on logical consistency, not a change of heart about crypto itself.
Precise.
And even before that final BTC spot approval, we did have some earlier signs, didn't we? Some indicators that the regulatory ice might be thawing. I'm thinking about the Ethereum futures ETFs.
Yes, those approvals back in, autumn 2023, they were a very important signal.
How so?
Well, approving Ethereum futures ETFs showed that regulators were getting comfortable with products tracking ETH derivatives. Again, largely because those futures trade on the highly regulated CME, which has strong surveillance sharing agreements. Now, futures products are generally seen as less complex to approve than spot, custody-wise. But their acceptance was a clear precursor. It was the SEC signaling, okay, we're comfortable with the price discovery mechanism for Ethereum.
Which logically leads to
The next step being the underlying spot asset. It shifted the regulatory question from, is the ETH market itself okay, to, can we figure out how to securely custody and audit the actual spot ETH? It paved the way.
Okay, so we've got the catalyst, this legal mandate, combined with just massive undeniable demand. Now let's get into the why. Why are ETFs such a powerful tool, such an effective bridge for this integration? Let's break down the benefits for different types of investors, starting with, say, the everyday retail investor, maybe someone listening who's curious about crypto.
Yeah, for the everyday investor, the appeal is really about simplicity and access, pure and simple.
How so?
ETFs just strip away so much of the complexity. You don't have to worry about setting up a crypto wallet, managing private keys, the whole self-custody thing.
Which can be intimidating, let's be honest.
Very intimidating. Or even just dealing with crypto exchanges, which can feel unfamiliar or confusing for people new to the space. ETFs make it incredibly easy.
You just buy it through your existing brokerage account.
Exactly. You can gain crypto exposure right within the traditional structures you already know and trust, like your retirement account, maybe a 401k if they allow it, or just your standard Schwab or Fidelity brokerage app.
So it turns this complex tech thing into just another line item, like buying a stock.
Precisely. A simple financial allocation decision, not a deep dive into cryptography.
Okay, that makes sense for retail. Now, what about the big players, the institutions? The benefit for them seems even more fundamental. We keep hearing about self-custody headaches.
Oh, absolutely. For institutions, ETFs solve major logistical and compliance problems. Think about a huge pension fund or a university endowment managing billions.
They have very strict rules, fiduciary duties.
Exactly. They might want exposure to Bitcoin's price potential, but their compliance departments, their risk managers, they just cannot stomach the operational burden, the security risks, the potential liability of holding actual private keys on their balance sheet. It's a non-starter for many.
So the ETF solves that how?
The ETF structure acts as a regulated container. They get exposure to the price movement through a vehicle managed by names they recognize and trust, BlackRock, Fidelity, VanEck, whoever. It's traded on regulated stock exchanges.
It fits within their existing framework.
Perfectly. It allows them exposure via a product that meets their strict regulatory and compliance requirements. For many wealth managers, family offices, even some hedge funds, the ETF structure is basically the compliance checkbox they needed before they could allocate significant capital.
Right. Plus, we shouldn't forget the professional traders in all this. The ETF isn't just about passive holding. The activity it generates actually creates opportunities for them, right? Arbitrage.
Yes, and that's crucial for keeping the whole system working efficiently. ETF activity creates constant arbitrage opportunities.
Okay, arbitrage can sound a bit like jargon. Can you break down how that works simply? Maybe across those three areas: spot markets, derivatives, and the ETF itself.
Sure. So arbitrage is basically just exploiting tiny price differences between related assets to make a risk-free profit, which in turn pushes the prices back into alignment.
Okay.
So imagine a big Bitcoin ETF sees massive inflows. Lots of people are buying shares. The ETF provider, the issuer, has to go out and buy actual Bitcoin on the spot market to back those new shares.
Right, the creation process.
Exactly. Now, that sudden buying pressure in the spot market might cause the ETF share price to temporarily tick up slightly higher than the actual value of the Bitcoin it holds, the net asset value, or NAV.
So there's a tiny gap.
A tiny fleeting gap. And professional trading firms, these authorized participants or market makers, they pounce on this instantly.
How?
They'll simultaneously do two things. They'll short the ETF shares, betting the price will come back down, and at the exact same moment, they'll buy the underlying spot Bitcoin.
Ah, capturing that spread.
Capturing the spread, yes. And by doing this in huge volumes, they force the ETF share price and the spot Bitcoin price back together. It keeps the ETF honest, tethered to the real asset value.
And this creates activity across.
Across the spot markets where they're buying BTC, across the ETF market where they're shorting or creating shares, and often in the derivatives markets too, where they might hedge their temporary exposures. It's this constant high-frequency activity that ensures the ETF actually tracks the asset price effectively.
Yes.
It's a critical, complex mechanism behind the scenes.
That makes a lot more sense. It's the plumbing that makes the ETF work smoothly. Okay, so to really gauge what we might expect from all this new capital flowing into crypto via ETFs, historical comparisons are useful, and the big one everyone points to is gold.
Yes, the gold ETF, ticker GLD, launched back in 2004. It's a classic case study.
What does that history tell us? What happened with gold after its ETF launched?
Well, it provides a really powerful and, frankly, very bullish potential roadmap. Before GLD launched in November 2004, getting exposure to gold was, well, it was cumbersome. You had to buy physical bars or coins, maybe invest in mining stocks, deal with futures contracts.
Not easy for the average investor or even some institutions.
Not at all. The ETF completely democratized access to gold as an asset class. And it unlocked massive amounts of new capital that flowed into the gold market money that was previously sitting on the sidelines.
And the price impact?
Critically, the price of gold doubled.
Right.
It went from around $400 an ounce at the time GLD launched to over $800 within just a few years.
Doubled.
Doubled. And that kicked off a much longer multi-year bull run for gold. So if you apply that same dynamic, easier access, democratization, massive new pools of capital, finding a regulated pathway to Bitcoin or potentially Ethereum.
It suggests the current inflows might just be the beginning.
It strongly suggests we could be in the early stages of a multi-year repricing event for these crypto assets, where potentially trillions of dollars of TradFi capital could eventually find its way in. The gold ETF playbook is a very compelling historical parallel.
That definitely sets a high bar for expectations. Okay, let's pivot then to the specific assets that might benefit most from this new wave of capital. Bitcoin obviously has already seen the impact. But who's next? Ethereum seems like the obvious candidate.
Ethereum, ETH, is arguably the biggest potential winner on the immediate horizon, assuming the spot ETFs get approved.
Why bigger than Bitcoin, potentially?
Well, spot ETH ETFs could certainly supercharge demand just by providing that easy access, similar to Bitcoin. But ETH has a unique feature that Bitcoin doesn't: staking.
Ah, the proof-of-stake mechanism.
Exactly. Since Ethereum uses proof of stake, the underlying ETH tokens held by the ETF could potentially be staked to help secure the network, and staking generates a yield, a form of passive income.
So the idea is the ETF could capture that staking yield and pass it through to the shareholders.
That's the potential game changer. If an ETH ETF can include staking yields, it transforms the product entirely.
How so?
It goes from being just a non-yielding commodity exposure like the Bitcoin ETFs or gold into a yield-generating asset.
Which makes it attractive to a different kind of investor.
Immensely attractive, especially to large institutions. Comparing it against, say, traditional bonds or other income-generating assets. A crypto ETF that also pays a yield, That becomes highly competitive in a portfolio allocation context. It could pull in capital seeking total return, not just price appreciation.
Okay, but hang on. Isn't staking kind of a regulatory minefield right now? The SEC hasn't exactly been friendly towards staking programs, often viewing the yield as potentially making the asset a security.
Yes. That is the major hurdle. You've hit the nail on the head.
Doesn't including staking dramatically increase the risk that the SEC delays or even denies these ETH ETFs if they see that yield component as an investment contract feature?
That is absolutely the key regulatory battleground and a necessary dose of realism here. The inclusion of staking definitely complicates the approval narrative. It touches directly on that huge contentious question. Is ETH a commodity like Bitcoin, or is it potentially an unregistered security, especially when staking yield is involved?
So what's the likely path forward?
It's quite possible, maybe even likely, that the SEC might first approve a plain vanilla spot ETH ETF, one that only holds ETH, without any staking feature initially. Just focus on the custody and spot price tracking.
Get that baseline approval first.
Right, and then the battle over adding staking yields could be a separate, potentially much longer and more intense regulatory fight down the road.
Yeah.
Asset managers are certainly thinking about it, maybe planning for it, but the path to a yield-bearing ETH ETF is definitely far rockier than the path for a non-yielding one.
That regulatory complexity makes sense, and maybe it explains why we're seeing asset managers already looking beyond ETH, too. These filings for Solana, SOL, ETFs, that seems like a big vote of confidence in an alternative Layer 1 protocol.
It absolutely is. It's a clear signal that the market, or at least parts of the institutional market, recognize that the crypto space has evolved and diversified beyond just Bitcoin and Ethereum.
What makes Solana attractive for an ETF?
Well, Solana has gained a lot of traction due to its high transaction speed, very low fees, and a pretty vibrant developer community building things on top of it, especially in areas like DeFi and NFTs.
So institutions are seeing it as, what, a legitimate competitor?
They're essentially signaling that they view Solana as having reached a certain level of maturity, market depth, and perhaps institutional acceptance to warrant its own regulated financial product. It's saying this isn't just a small altcoin anymore. It's a significant platform.
And then there's the idea of these basket ETFs, the DeFi indexes. That seems like an even more efficient way to get broad exposure.
Yes, that concept is gaining serious traction. And it could be incredibly efficient for channeling new capital into the ecosystem.
How'd that work?
Instead of picking just one winner, one specific Layer 1 or DeFi app, a single ETF could track a curated basket of, say, 10 or 20 leading projects across the decentralized finance space.
Like decentralized exchanges, lending protocols.
Exactly. Lending protocols, liquid staking derivatives, maybe some synthetic asset platforms. A diversified portfolio within one ticker symbol.
The appeal there for an institution seems obvious.
Huge. It pumps liquidity broadly across the ecosystem rather than concentrating it on one asset. And for compliance, it offers diversified exposure under a single, easy-to-manage line item. Much simpler than trying to pick and custody 20 different tokens.
Okay, one last piece on the mechanics here, custodianship. Wall Street needs someone reliable and regulated to actually hold all this underlying crypto for the ETFs.
This is absolutely critical, and it's where you start to see the potential for centralization in this new institutional gateway.
And the big name that keeps popping up is Coinbase.
Yes, Coinbase, specifically their Coinbase custody arm. If you look at the filings for many of these new ETFs, especially from the biggest players like BlackRock, they explicitly name Coinbase as their primary custodian. Some also mention surveillance sharing partnerships with Coinbase's exchange.
That's a massive endorsement.
It's huge. It basically cements Coinbase's position as the major institutional gateway, at least for now. By being the trusted entity holding the keys to potentially trillions of dollars worth of crypto backing these ETFs, they become this central regulated pillar supporting the entire TradFi crypto integration. It's a very powerful position.
Right. It's easy to get caught up in the excitement, the billions flowing in, the potential for prices doubling like gold. But we absolutely have to pause and look at the risks. This wave isn't all smooth sailing. First off, those immediate regulatory roadblocks, they're still very real, aren't they? Yeah. Especially for the more ambitious altcoin ETFs.
Oh, absolutely. We can't gloss over that. While the grayscale ruling forced the SEC's hand on spot BTC, the agency still has significant power to stall, delay, or even deny other products.
On what grounds?
They can argue about specific market structures, concentration risks, potential for manipulation. especially for assets that aren't traded on highly regulated futures markets like the CME.
So things like Solana or maybe even smaller layer ones or DeFi tokens.
Those are definitely more vulnerable. The SEC looks closely at things like, is the asset traded across multiple reputable regulated exchanges? Is the trading volume deep enough and distributed enough to prevent easy manipulation?
And the smaller the coin, the harder it is to meet those standards.
Generally, yes. The smaller the market cap or the more trading is concentrated on just one or two, maybe less regulated offshore exchanges, the easier it is for the SEC to raise that manipulation concern as a reason to delay or deny. We could see a much longer, perhaps more painful process for approvals outside BTC and possibly ETH.
So the regulatory clarity for Bitcoin doesn't automatically extend down the chain.
Not at all. That whole security versus commodity debate still hangs over many assets, giving the SEC plenty of legal wiggle room to slow things down for anything they deem too risky, or where the trading picture isn't crystal clear.
Okay, regulatory risk noted. The next risk feels more philosophical. It gets to the heart of what crypto is supposed to be about. This is the paper Bitcoin dilemma.
Yes, or paper crypto more broadly. It applies to any crypto asset held synthetically within an ETF.
What's the core concern there?
The risk is that these ETFs massively increase the number of people holding a financial claim on Bitcoin or Ethereum, the paper version, without necessarily increasing the actual use, circulation, or on-chain verification of the real underlying token.
So you own shares in a fund that owns the crypto, but you don't own the crypto directly.
Exactly. You hold a security managed by Wall Street that represents the asset, but you don't hold the actual private keys. You can't send it on-chain. You can't use it in DeFi. You can't self-custody it.
And this creates a potential disconnect.
A potential disconnect, yes. You could have the price soaring, driven by demand for the ETF shares in traditional markets, but potentially the underlying network's health or activity doesn't grow proportionally. It might become somewhat hollow.
Which leads directly into another risk, a potential change in user behavior, dampened on-chain activity.
Right. If it becomes so much easier, cheaper, and more convenient to just buy the ETF in your brokerage account.
Why bother with the complexity of setting up your own wallet, learning about seed phrases, interacting directly with the blockchain?
Exactly. You might see this phenomena where the ETF inflows, while pushing the price up, could actually discourage genuine grassroots engagement with the technology itself.
People opt for passive financial exposure instead of active participation.
Yes. If the convenience of the ETF leads investors to choose the financial product over holding the real tokens and using the network, it could inadvertently reduce the overall decentralization, the developer activity, the general vibrancy of the Web3 ecosystem. The number of actual users driving utility, not just hodlers driving price, might shrink relative to the massive financial market sitting on top.
This whole integration, then, forces us to confront this core philosophical conflict. The impact on the Web3 ethos when Wall Street comes knocking, or rather barges in. Let's lay out the two sides.
Yeah.
First, the pro-Wall Street argument. Legitimacy.
Yeah, the pro-integration case is financially very compelling. There's no denying that this ETF wave brings significant legitimacy and credibility from the traditional financial world to crypto.
An institutional stamp of approval.
A huge one. When names like BlackRock, Fidelity, Franklin Templeton are offering these products, managing potentially trillions in assets eventually, it signals to the rest of the world that crypto is a serious, viable, long-term asset class.
And that legitimacy could attract more talent, more builders.
Absolutely. That credibility can draw in more skilled developers, more entrepreneurs, more established companies who were maybe hesitant before. If the ecosystem gets flooded with reliable, institutional-grade liquidity, it makes it easier to fund ambitious projects, build next-generation applications, and really scale the technology. It legitimizes the whole industry and could accelerate mainstream adoption dramatically.
Okay, so that's the bull case for integration. Legitimacy, capital, talent, adoption. But it comes at a potential cost. And that brings us to the anti-Wall Street argument, focusing on centralization and sovereignty.
This is the crux of the debate, the existential question, really.
Does crypto lose its soul, its core purpose, when Wall Street institutions start controlling the majority of the capital flowing in and, more importantly, custodying the underlying assets?
That's the fear. And it's not unfounded. Think about the custody structure we just discussed. If down the line, a handful of very large, highly regulated custodians like Coinbase, maybe a few big banks if they get into it, end up holding the private keys for a significant chunk of all the Bitcoin or Ethereum backing these ETFs.
Trillions of dollars worth.
Potentially trillions, yes.
Yeah.
That introduces a massive point of centralization. These custodians, these ETF issuers, they are regulated entities. They have to comply with government regulations, subpoenas, potential asset freezes, capital controls.
Things that crypto was arguably designed to resist.
Exactly. If the majority of the usable supply of Bitcoin or ETH ends up locked in these regulated vaults, controlled by entities that must comply with state directives, does it fundamentally compromise the censorship resistance, the permissionless nature, the decentralization that made crypto revolutionary in the first place?
So you gain financial access and legitimacy.
But potentially at the cost of the underlying technological sovereignty. The price might go to the moon, driven by ETF flows, but the network's original promise of decentralization could be significantly weakened.
It becomes a system where the price is set during New York trading hours, influenced by decisions in regulated boardrooms.
Rather than by a globally distributed network of peers operating 24/7. The very features that made crypto unique and attractive to its early adopters, sovereignty, resistance to control, could be eroded by the very financial instrument that brings it mainstream success.
That's the paradox, isn't it?
That is the central paradox we absolutely have to watch and navigate over the next 5–10 years. The ETF is the key to unlocking massive financial integration, but it simultaneously introduces this profound risk of re-centralization back into a system designed to be decentralized.
Okay, let's bring this down to actionable insights for the listener. Someone tracking this story, wanting to stay informed, maybe even position themselves. What should they be watching? What are the key data points, the metrics to monitor in real time?
Right, let's build out an analytical playbook. First, the simplest one, but maybe the most impactful for short-term moves. Watch the calendar, specifically the regulatory calendar.
You mean SEC decision deadlines?
Exactly. Keep a close eye on the final deadlines for the SEC to approve or deny upcoming ETF filings, whether it's for ETH, SOL, those DeFi baskets we talked about, whatever comes next.
Why are those dates so critical?
Because crypto prices have shown, historically, a very strong tendency to react significantly around those announcement dates. Big rallies on approval news, sharp drops on rejections, or even delays sometimes.
So knowing the deadline tells you when volatility is likely?
Precisely. Tracking those specific dates gives you a heads up on planned market pressure points. It's not just watching the news, it's anticipating scheduled catalysts.
Okay, calendar watching is step one. Beyond that, you obviously need to track the money itself. The ETF flows, inflows, and outflows. Where can people find that data, and what should they look for?
Yeah, tracking the flows is fundamental. It's probably the single best real-time indicator of institutional sentiment and momentum for the asset covered by the ETF.
Where do you find it?
You can get this data from financial terminals like Bloomberg if you have access. But increasingly, you can find it directly on the websites of the ETF issuers themselves. They often report daily flows. Financial news sites like Reuters, Bloomberg News, CoinDesk also aggregate and report these numbers daily.
And what constitutes a significant flow? What should people look for?
Well, for the Bitcoin ETFs, for example, seeing sustained net inflows of, say, $100 million or more per day over several days is generally considered pretty significant. It shows strong buying pressure.
And outflows.
Conversely, if you start seeing a string of days with heavy net outflows, maybe $50 million or more leaving the funds each day for a week, that's a clear signal of institutional de-risking or profit-taking. And it often precedes or coincides with price corrections. So tracking the size and, importantly, the persistence of the flows is key.
Got it. Now, for listeners who want to go a bit deeper, get into the weeds analytically, what are some specific concepts or charts they could track to gauge how deeply integrated crypto is becoming and how it's changing market behavior?
Okay, yeah, we can definitely dig deeper. First, look at correlation shifts. This is really interesting.
Correlation between crypto and traditional markets.
Exactly. Track how the correlation between Bitcoin and eventually Ethereum, if its ETF gets approved, changes relative to traditional benchmarks like the S&P 500 or, maybe more relevantly, the tech-heavy NASDAQ 100.
What are we looking for there?
Historically, one of Bitcoin's selling points was that it was largely uncorrelated, or at least had low correlation to stocks.
Right.
It was seen as a potential diversifier.
Right.
Post-ETF, if you see that correlation start to strengthen significantly, say, consistently moving towards 0.7, 0.8, maybe even higher during risk-off periods, that's strong evidence.
Evidence of what?
Evidence that crypto, or at least ETF-accessible crypto, is increasingly trading like just another risk asset, like a high-beta tech stock. It moves more in lockstep with the broader regulated markets. That rising correlation is the measurable fingerprint of Wall Street's growing influence. It shows integration in real time.
That's a great point. Okay, correlation shift. What else? How can we measure the sheer scale of institutional presence?
A good way is to compare the total assets under management, the AUM, held in all the crypto ETFs combined, against the total market capitalization of the underlying crypto asset, like Bitcoin or Ethereum.
So ETF AUM as a percentage of total market cap.
Exactly. That ratio is critical. As the ETF AUM climbs and becomes a larger and larger percentage of the total available supply or market value, say it gets to 10%, 15%, 20%.
Then the ETF flows start to really dominate price discovery.
Precisely. At that point, the buying and selling decisions driving the ETF flows become a dominant, maybe the dominant, driver of the asset's price, potentially overshadowing flows from retail investors or on-chain activity. It tells you how much influence the institutional ETF channel has gained. You can find ETF AUM on issuer sites, and total market cap is available everywhere.
Okay, that makes sense. Now, earlier we talked about arbitrage and professional traders. How can we see the ripple effects of ETF demand in the more speculative parts of the market, like derivatives?
Ah, yeah, the derivative spillover. A key metric to watch here is funding rates in the perpetual futures markets.
Funding rates. Remind us what those indicate.
Funding rates are payments exchanged between long and short positions in perpetual swaps to keep the swap price pegged to the underlying spot price. When funding rates are high and positive, it means traders holding long positions, betting the price will go up, are paying a premium to those holding short positions.
So it measures bullish leverage or sentiment?
Essentially, yes,
Yeah,
it
yeah.
shows the demand to be leveraged long. So if you see massive inflows into the spot ETFs happening, and at the same time you see funding rates in the perpetuals market spike significantly positive,
What does that tell you?
it suggests that the ETF inflows are potentially triggering a wave of follow-on speculative buying, often from retail traders using leverage in the derivatives market. They see the ETF buying, they get bullish, they pile into leveraged longs.
And that can signal.
It can signal that the market is getting overheated, maybe too quickly, fueled by the ETF enthusiasm. Very high funding rates often precede sharp corrections as the longs get squeezed out. So it's a good gauge of short-term speculative froth driven by the ETF narrative.
Okay, funding rates. And finally, looping back to that philosophical debate about centralization and network health, how can we use metrics to perform a sort of health check on the decentralization aspect? How do we try to quantify that paper Bitcoin risk?
This is crucial for tracking the deeper impact, the on-chain health check.
Hmm.
You need to monitor whether the rise of ETF adoption corresponds with changes in actual on-chain activity.
Like what specifically?
Look at metrics like, are the number of active wallets on the Bitcoin or Ethereum network growing proportionally to the price increase driven by ETFs? Or is the price rising while active usage stagnates? Also, track the flow of coins moving off exchanges into self-custody wallets. Is that trend slowing down or reversing as people opt for the ETF instead? If you see less activity, fewer transactions, maybe slower growth in active addresses, despite a rising price and huge ETF AUM,
That could be evidence.
that could be measurable evidence supporting the concern that ETF convenience is leading to more passive, centralized financial exposure at the expense of active, decentralized network participation and genuine user adoption. It helps quantify that trade-off we discussed.
This all really forces the individual investor, anyone listening, to confront that core sovereignty question, doesn't it? You have to think about your own goals, your own thesis.
Absolutely.
Do you prioritize the absolute control and sovereignty that comes from holding your own keys, buying actual crypto, even with the added complexity and responsibility?
And not your keys, not your coins philosophy.
Right. Or do you prioritize the simplicity, the convenience, the integration into your existing financial life that the ETF offers, accepting that you're holding a representation of the asset within the traditional regulated system?
That is the fundamental choice this whole ETF wave illuminates. It's a direct trade-off, convenience versus control. The ETF gives you Wall Street's familiarity and regulatory wrapper, but relies on centralized custodians. Holding the actual asset gives you true digital sovereignty and censorship resistance, but demands significant personal responsibility for security.
Both paths give you price exposure, but they have vastly different implications for the future of Web3 and for your own financial autonomy.
It's a choice everyone interested in this space now has to consciously make.
So we have covered a huge amount of ground today. This deep dive into the crypto ETF wave really shows a financial system in the midst of rapid, almost violent change. It's driven by that legal mandate from the Grayscale case and just undeniable institutional demand.
Yeah, we've seen the flood of proposals, dozens of them. We talked about those massive initial inflows, over $10 billion right out of the gate for Bitcoin ETFs in early 2024. And we've really wrestled with these competing forces
The lure of financial legitimacy, the institutional stamp of approval.
versus the very real risks of creeping centralization and potentially undermining the original crypto ethos.
The gold comparison gives us a sense of the potential upside, maybe years of repricing ahead.
But that paper crypto dilemma, the risk of dampening real on-chain activity, highlights the potential downside for the network itself. The institutional bridge is being built, no doubt about it, very quickly. And custodians like Coinbase are becoming central pillars.
But we have to keep asking, who is crossing that bridge and what values are they potentially leaving behind on the other side?
It's a critical question.
Which really raises that final important question for all of us watching this unfold, and something for you, the listener, to really think about. Are these ETFs ultimately bullish? Because yes, they bring Wall Street money, potentially trillions in liquidity, accelerating adoption and legitimacy for crypto.
Or are they actually, in the long run, bearish for the true vision of Web3? Because they risk centralizing too much control, too much exposure in the hands of just a few massive traditional finance players, ultimately undermining the very decentralization that was the founding principle.
Bullish for the price, maybe bearish for the soul.
That's the paradox. And navigating that paradox is going to define the next decade of digital finance, I think.